We are ready to get started. I want to introduce, first of all, I want to just say we are going to be doing a lot of these different types of classes. Please tune into any of them. They're going to be on a wide variety of historic preservation topics. So next week we have wood window repair. We have a talk on historic architecture and neighborhoods. We've got best practices in historic renovation. So we're here. If you have ideas for other things you want to learn about while you're stuck at home, let us know. My email is smohan@prcno.org. You can go to our website and reach out to us. And please do follow us on social. You probably do. That's probably how you found out about this, but tell your friends. We want to try to, give people some historic building information as much as we can. So without further delay, I want to introduce our panelists. Katie Witry is the founder of the Witry Collective brokerage. She is an incredible realtor, and she is a board member of the PRC and has been involved with the PRC's education programs for over a decade. Joe Uzee is a mortgage originator and VP at Gulf Coast Bank and Trust. Also has been involved with the PRC's education programming for over a decade. And we're just really grateful to them for sharing their sort of knowledge and the research that they've been doing over the past couple of weeks to keep up with how things are shifting. And I am going to let them take it away. Just so you know, Joe has called in today, so you'll just see sort of his phone number pop up. There's actually an interesting issue for those of you who have been reading the news about Zoom today. Because Joe works with a bank, he has different, he's not able to sort of access Zoom the way some of us are who are just working from our regular old home computers and things like that. So the good news is he's got awesome information to share regardless of the format. So Katie and Joe, you guys can go ahead and take it away.
All righty. Thank you, Serena. I think I'm going first, huh, Katie? Can y'all hear me?
Oh,
hey,
yep.
Serena, can you all hear me? Okay,
Yes.
Great. No problem. I'll go. All right. Thanks. Yeah, so at least if you bank with Gulf Coast Bank, everything's protected, right? Because our IT is so encrypted, and hopefully Zoom has this patch fixed up in the next couple of weeks, and I'll be able to participate video. Anyway, thanks, Serena, for organizing this. The more knowledge that we get out to the community and to homeowners, buyers, and just our citizens, the better, especially in this time of turmoil. So I hope everyone is doing all right through this pandemic and quarantines. We've had, blessings and curses, obviously, but I think we'll all get through it. So with that, I would like to say one thing to my peers. I don't know if there's any lenders on this call, but personally, I have a sphere of people who I lean on, and they lean on me. And over the past several weeks, we have been sharing information, data, just trying to get through it, which makes it better for you all as potential home buyers. And if you're a homeowner already that has a mortgage, these are volatile times, but we will get through it. And yesterday I was on a national call with a national lender with some very high profile people in the mortgage industry. And we had a hashtag better together. So not just in the mortgage lending, but just as a country and as a world, we're all better together when we try to work through difficulties. So with that being said, let's start off mortgages with what else but interest rates. Okay, so first of all, interest rates are still great. There's volatility, but they're still great. A little bit of history over the last several years, the highest that rates got were at the end of 2018, and rates went above 5%, 5% to about 5.3. I look back at my closed loans, and that's the rate that home buyers were getting at the end of 2018. Last year, to start 2019, the market started at about 4.75. And we know that last year, the Fed started reducing rates because they realized that in 18 and 17, they were too aggressive with their rate increases. So they started reducing rates last year in 19. So by the end of 2019 and the start of this year, we were in the upper 3% range. Then came COVID-19, and then came 2 Fed reductions to interest rates that on paper look great. Okay, the Fed reduced interest rates so that it would keep the economy going, keep people confident, and we went from there. Sometimes good intentions don't always turn out the way that they were expected. So the Feds, with those 2 reductions, brought rates down, but it also caused some turmoil in the mortgage market. And let me just explain why. I'm going to try to do it in layman's terms. But when you reduce the rates to 0, there are investors who buy mortgage-backed securities. And what they felt was the rates were too low, so their investment wasn't going to return the income that they wanted, okay? Because they saw risk, and there is risk, right? Our economy is coming to a slow halt. People may be unemployed, incomes may be cut. So with that, there is risk in people paying their mortgages. So those investors said, we're not going to buy mortgage-backed securities at these low rates. So as a result, rates went back up. Okay, the reverse happened to what the Fed's intent was. So to kind of add on to that, the Fed came in and said, look, we're going to buy mortgage-backed securities to solve that problem. So rates leveled off. But if the Fed continues to buy these mortgage-backed securities, right, and the rates do go down lower, that causes a problem with the mortgage servicers that are out there, right? So the mortgage servicers are the companies who we pay our mortgage payments to every month. So if you're a homeowner out there, you're paying XYZ company. They collect your payment and they pay the investor. That's an asset for that company. So they're foreseeing now that my asset may be diminished in value because rates are going down and those loans may pay off. Therefore, their asset is diminished in value. So with that being said, there's prices that are adding on to the servicing side of it. In fact, last week, it was pretty brutal a week ago on Friday when all of the mortgage companies started getting what was called margin calls. So the servicers were calling for checks from us mortgage lenders with the loans that we have locked in, which just caused a problem. So in a nutshell, the market is volatile. And you as a consumer may say rates should be 2%, 2.5%. I get calls every day, Joe, I want to refinance. And I tell my client, well, but you have a 3.75 rate when you bought your house last year. Yeah, but aren't rates 2% or 1.5%? So the idea on the street is that rates are super low. They're not. And I don't think that they're going to get super low to 1%, 1.5%, or 2%. I think that as we get through this, the rates are going to level off into the 3 range, mid-3s, and that's where we are today. We'll bounce up and down from there over the next several months as we get through COVID. But I just wanted to give you a spiel on where rates were. So if we're at rates in the 3s, those are awesome interest rates. They may not be as low as they were 3 or 4 weeks ago because we did get into the very low 3s, but we've adjusted out of that. So let's talk about news.
Hold on, Joe. Joe, can you,
yeah.
There was a question a few minutes ago. Can you just concisely define mortgage-backed securities real quick?
Sure. So when the Fed reduces the rate, right, they're not reducing a mortgage rate per se. They're reducing the rate that banks are charged, that banks charge each other overnight to lend money back and forth. When the Fed reduces rates, the rates that are directly affected immediately may be car loans, okay, maybe credit cards. So I've seen it already, like even 2 weeks ago, car loans, you can buy a car, 84 months, 0% rate. Okay, that's awesome. Mortgages are not tied to that Fed rate. They are tied to mortgage-backed securities and the bond market. Okay, so the bond market is what affects the rates. So lenders, okay, we tie our rates to that bond market. As the price of that bond goes up, that's good. Yield goes down, rates go down. And we've seen that happen, except that the investors who buy those mortgage-backed securities don't want to buy at that low yield, okay, because of the risk that I just spoke about. So the mortgage-backed security is what drives the mortgage rates, and that's what we as lenders hedge, to quote our consumers, the mortgage rates. So if the investors aren't buying those mortgage-backed securities, that's where the Fed stepped in and said that we would buy them. Well, if the government steps in and buys those, over the investors, that's where we had the issue with the servicing and the payoffs and things like that. But the mortgage-backed security are the paper that's, sold in the secondary market to investors, You may have some investments in low risk. It's probably in some type of bond or mortgage-backed security. If you're in high risk, you're in the stock market, but you want to diversify. So that's a part of investments. So I hope it may have been complicated, but that's the best way for me to explain how mortgage rates are priced.
That's great. Thank you, Tim.
So back into news. So let's just look at this week. I'll give you some headlines. We've had a ton of headlines, but the United States Post Office may close in June because there's no relief in the stimulus package. I don't think the post office is going to close, but that was one of the headlines, right? Unemployment. Total projection for unemployment after all of this is said and done and through the COVID pandemic, projected 47 million Americans may be unemployed. That's a 32% unemployment rate. If you look back in history in the Great Depression, the unemployment rate was 24.9% at its peak. So we're looking at unemployment rates that exceed the Great Depression, okay? Today, unemployment came out at 4.4%. Now, before COVID, we were running low unemployment, historically low unemployment below 3%, well below 3%. And now we're at 4.4%. So that's over a full % increase on unemployment when it was announced today. And actually, it's a lot worse than that, but we don't have all of the data. The GDP this second quarter is a negative 30%, okay? That's historically low. And it's projected that it won't recover until the third quarter. So we just started quarter two, right? So we have 3 months of quarter two. We're not going to see a recovery, and that's not getting back to where we were. That's just starting to recover until the third quarter. The mortgage services, who I just spoke about, they're bracing for 15 million U.S. mortgage defaults. Okay, now that's not, I don't want to confuse foreclosures, but that's people not making their mortgage payment. 15 million United States citizens will default on their mortgage. That's projected. That's what they're bracing for. So when you see that, investors, right, they get worried, they get scared, they get nervous. Okay, this is not similar to what happened in 2007, 8, and 9, where we had the mortgage crisis. Okay, we had the mortgage crisis for a variety of reasons, but it has nothing to do with what we're experiencing now. We're experiencing a pandemic that is affecting every city, town, community, state, country. It's global. So we can't go anywhere to escape it. So when investors see this news, they get nervous, right? So they start to change the rules. And that's what we've seen in our industry. We've seen somewhat of a retraction in the rules. So credit scores have to be higher. Processing income to verify income has become more strenuous. We have to do more than what we did 3 months ago. The loans that have been affected the most are government loans, which are your FHA, your VA, and your rural development. Also hit hard were your non-QM, non-qualified mortgages, which would be some of your out-of-the-box mortgages. Those are almost non-existent. But also mortgages that got hit hard are our jumbo loans. Okay, so those are mortgage loans on a single-family residence that exceed $510,400. That's a jumbo loan. So you're buying your $1 million house, you're putting down 10% or 20%, you're above that conforming loan limit. That rate is always a little bit higher than market anyway. Well, now it's a lot higher than what market is. Okay, so those are the loans that have been affected the most.
Hold on, Joe.
I want to touch on.
Can I ask you a couple of questions from the audience before you move forward on that thought?
Sure.
Sorry, going back just a minute. Someone asked they said the 30% noted is an annualized figure. Does that mean that it's 7.5% for the quarter?
I don't have that on the GDP quote.
Yes, I think so.
Yeah, I don't have that exact data. That was a headline on my call from yesterday.
Okay.
So, like I said, the point of that statement wasn't to give it's to let you know that there's trouble in the economy. We all know that there's trouble in the economy, but these are numbers that investors and the market is looking at when they're making decisions on mortgage loans.
Okay. And then the second question is, can you explain how FHA and VA have been affected? And that may be coming later. I just wanted to make sure you knew that question was out.
Well, it is kind of, so I didn't know if we wanted to run through this and then let Katie talk and have questions at the end, or if you want me to ask questions going along, that's fine. But the reason why government loans have been affected the most is because the servicing on government loans costs the services the most, okay, because of the guidelines that Ginnie Mae, that's who purchases the government loans, your FHA, VA, and RD. They put more restrictions on the mortgage servicers on those loans. So remember what I said, the servicers right now, their asset has been depleted and they have all of these restrictions. Therefore, they're putting more restrictions on these loans to originate them. Okay, so they're not going to do an FHA loan at a credit score below 660 on a refi. Right now we're limited at 640, but before this week, we can go down to a 580 on an FHA loan. So they jumped, 50 points in a credit score. So that's what you're seeing when I'm saying that the government loans are affected. It's mainly credit score issues where the borrower who we try to fit into an FHA loan that had a lower credit score, they're not able to get that now because of the restrictions that FHA has put on that. Was that in on that question, Serena?
Yeah, I think that's great. Thanks.
Okay. So
I just want to add one thing. I just want to add one thing, Joe, that it's definitely for people out there that are currently in the pipeline for your FHA and VA. That is happening even after you've got your clear to close and your closing disclosure sent out. We've had a few situations this week where they're re-verifying their employment and they're going back, at least another year and asking for some documentation. So even if you're planning on closing, all of a sudden those loans are going through scrutiny that are currently in the pipeline as well.
Great point, Katie. And that's true. That's actually happening. So that's why, when these rules change in the middle, it lenders that we've actually had to shut some closings down because of the rules that changed. And that's not typical. So that's why you're seeing, these restrictions being placed in now so that we can actually be ahead of the curve for when they continue to change on us. So I just want to touch on some projections for after this is all over, right? And Katie will touch on the market and housing, but this is the mortgage view of it. We feel that house purchasing will actually increase after COVID, okay? And you may ask me why. Well, first of all, this should be our busiest time of the year. And Katie will attest to this. It's springtime. This is when people tend to list their houses and move because school's about ready to be over. And during the school year, they don't like to uproot their kids and move. So this is when people buy and sell houses, all right? It's put on a severe hold right now because people can't go look at houses. So once this is over, those same people are going to want to buy, all right? Also, we feel that after COVID, people who were well qualified to purchase homes but didn't live in a house, they lived in a condominium, they lived in an apartment situation, right? They may rethink this and say, you know what, if I ever have to go through this again, I want to live in a house with my own backyard, my own swimming pool, my own neighborhood where I can walk, not in an apartment style living, okay? So this is national, right? This isn't just New Orleans, but that is going to be what we feel is the mindset of many people who are going to now be in the housing market that weren't in it before. They were content to live in an apartment style living. However, there won't be a rush to sell. So homeowners who own houses now, after COVID, they may not be in the rush to sell. They're going to let things settle down and think about it, okay? Let their assets grow back, get back to work, get back to normalcy. So as a result, there may be some low inventory in housing. Again, I don't want you to say specific to New Orleans, but nationally, so low inventory. Appreciation in housing, however, may take a short-term hit. So this isn't to say that house prices are going to skyrocket. Appreciation will actually take somewhat of a hit for the short term. And that's all I want to say about housing. Katie will give her view on it after I finish up. So rates projected. This is from mortgage bankers, hot off the press this morning. They feel that rates will settle into a 3.3 to 3.5 range for the rest of 2020, which is awesome. Okay, so that's a great rate. Right now, we still have volatility. So if you're speaking to a lender, we may quote you 4.25 at par, meaning no points to pay. We may quote you 3.75 the next day. We may be at 3.5 today and then go back up to 3.8. It's very volatile on a daily basis. Those still aren't terrible rates, but they will settle into 3.5 according to some mortgage bankers. So realize that after this all settles down, right, mortgage lenders and the lending environment, we're going to be at a capacity. Okay, I don't want to say we're busy right now, believe it or not, with the refis, but there will be a capacity issue when it all settles down and activity really gets started. And I say that, why? Because realtors need to understand contracts may not be able to close in 30 days. They may be stretched to 45 or 60 at times. You as a buyer need to realize that you'll be jumping through more hoops. It may be harder to get a lender on the phone if we're at capacity, right? So I want to take care of every client that comes across my phone or my desk or into my office. But if we're at a capacity issue, I just want you to be aware of that, you know, when you're trying to speak to your lenders.
Joe, can you still lock in a mortgage rate?
Yes, you can. That has been a little bit of an up and down over the last couple of weeks. For 3 days this week, we were not locking our loans until we had a conditional approval. Okay, we changed that this morning, so we can lock in loans. But some lenders put a halt for like 2 weeks a couple of weeks ago. But most lenders and most of the lenders in New Orleans, we can all lock loans. I know one lender yesterday who I spoke to, they would only lock the loan in once the client had fully applied, had fully signed all of their loan applications, paid for their appraisal, and gave what was called the intent to proceed, and turned in all of their credit docs. So, you know, there's some restrictions, but you can lock, to answer the question. And you may ask why can't we lock? The reason is because of what happened last week with the margin call. So if a lender has $10 million locked in and they don't deliver that $10 million, they get penalized. So if a borrower, you know, lost their job and now they didn't qualify, or they were rate shopping and they think they can get a lower rate somewhere else, that's fallout. So we don't deliver those loans. We still have to pay the hedge for that. And normally they all replace each other, but in a volatile environment like that, lenders, you know, really started to monitor the pipeline and say, how much of this volume are we really going to pull through to a close? So I hope that answered that question, but yes, we can lock. We feel that with low rates, there will be some refis. There are already refinances right now. However, most refinances right now that are in my pipeline are rate term refinances, meaning I want to lower my interest rate, reduce my payment, and or reduce my term. My payment may go up, but I'm cutting years off. Industry feels that nationwide, the bulk of refinances may also be to consolidate debt after COVID, okay? So in other words, people's assets have depreciated in their retirement, their 401k, their stocks, their mutual funds. Their house did not depreciate. So they may take advantage, and it may be wise to be able to consolidate some debt at a low rate with the house as an asset, which frees up monthly payment, right? The government's going to give out, what, $1,200 a few times, whatever. But if you refinance your house, that's forever, right? You refinance onto a low rate, consolidate debt, put yourself in a better financial situation, then that's forever. That's for the next 30 years. That's what industry thinks, right? When I have a client, should I refinance or not, I'm looking at the full picture. A refinance to consolidate debt is not for everyone, but it is for some people. If you're able to free up some credit cards that you're making $200 or $300 payments on, and now we've consolidated that into your house note and you've eliminated $600 a month in credit card debt, that's real money back to your bottom line every month. Question, when do I do it, right? Do I think the rates are at the lowest right now today? No, but I don't know when they are going to become the lowest, right? And if they do become lower, right, or reach a lower level, I don't think it's going to be that much better than where we are now. So best advice is you analyze the situation, you speak to your lender. If it makes sense, do it. Don't wait for the perfect moment. That perfect moment may never come. I have a saying, pigs get fat, hogs get slaughtered. Be a pig, not a hog, right? Do it, make a decision, feel content with it, and go on. And take advantage of the low rates. The good news for purchases is that rates will be at these historic lows projected through the rest of 2020 once we get through. They're low now, but once we get through COVID and we have a settling down, I think there's going to be more normalcy and less volatility that we see now. And these rates will actually increase a little bit in 2021, but they'll still be at low rates. I did speak about the jumbos, which are tough, the non-QM. It is tough to get a renovation loan right now, I'm just being honest. The FHA 203K, which again is an FHA loan, it's tough to get. Some lenders have backed out of that. The investors don't want to purchase those loans. So it may be tougher to get that type of loan going forward. So those were a few things on the market. I do want to talk about the mortgage deferments that's in the news. It is true. If you have a mortgage and you've been laid off and you cannot make your payment, you cannot be foreclosed upon. Your lender cannot rate you past due to the credit bureau. That's wonderful. That's really a good thing. However, the way that news is portrayed to you, a lot of people, because I've had the phone calls, Joe, I don't have to make my payment for 3 months, right? First of all, I'm not the servicer, right? So you have to call the company that is servicing your mortgage to make sure that you're on the same page with them. Okay, some mortgage services will say, sure, you can defer your payment for 6 months, for 3 months, or you pick. However, find out when you have to make up those deferred months. So if you don't make your payment for 3 months, some services are going to say, after month 3, when you start making your payments, you have to make up all 3 months at that time, which is huge, right? My mortgage payment is $1,000 a month. I skip 3 months. Guess what? In month 4, you owe your servicer $3,000. So be on that same page. Some servicers will put that mortgage payment at the back, okay, which is fine. That actually spreads it out further. But be on the same page with what the rules are with your servicer. The rule is, my rule is, if you can make your mortgage payment, don't defer it, okay? Because you have to pay it sooner or later. This isn't free. It's not like you have a pass to not pay your mortgage. In fact, if you go back to what I said a few minutes ago, that it's projected that 15 million Americans are going to default on their mortgages, that's what I'm talking about. Guess what? If the mortgage payment isn't made, that servicer, who, like I said, has an asset that's depleted right now, they still have to pay the interest to their investor. So they have to make that payment. So you can see that we could have a somewhat of a difficult situation in the mortgage world if everyone decides, I'm going to defer my mortgage payments right now. We may actually see rates go up pretty substantially if that happens, because these servicers are going to have to, you know, collect their money, which how are they going to do that? They're going to increase rates. You know, what they're going to do is increase the risk, which in turn causes us to have to increase rates based on what we have to deliver to those services. So you can see how that cycle works. As far as mortgages, I've seen, and Katie will touch on this, there's COVID disclosures that I'm getting with my purchase agreements now. Before we used to get the natural disaster disclosure, right? If a hurricane comes and after it passes, everybody agrees to go to the act of sale as long as the house didn't get destroyed. Well, now we're starting to see COVID disclosures that if title is delayed or you get laid off or, you know, different things will happen. Appraisals, our turnaround time on appraisals has really increased. In other words, we used to get appraisals back in 2 to 3 business days. We're seeing over a week now because a lot of appraisers are not appraising. They don't want to go into houses. So our rotation, our pool of appraisers has shrunk. And that's not just at my bank, that's at every lending institution. Therefore, less appraisers, it's slower to get an appraisal. Fortunately, there are some guidelines that have eased up on the inspection. So appraisers don't always have to go into the house. They can do drive-bys and take pictures off of the MLS. But with far fewer appraisers out there, it still takes a little bit of a time to get them back. IRS transcripts, lenders need IRS transcripts to often approve the loan and give the final clear to close. The IRS has shut down that portion of their operations. So it's tougher. We can't get IRS transcripts from the third parties that we rely on. So we can accept our clients. They're able to log into irs.gov, but sometimes that's slow. They don't know how to do it. They've never done that before. So and sometimes they don't get it all the time. The IRS site might be down, but that delays closings. And I spoke on verifications of employment where lenders have to take extra steps to verify employments. You know, sometimes we just need a paycheck stub and a W-2 and a verbal. We need to dig a little bit more now. Hey, are you going to keep this borrower employed? Are you expecting a shutdown? Are you expecting diminished wages? So we have to take those extra steps, which obviously takes extra time in approving the loans. So that's all I had. I hope I touched on a lot of points, but it's food for thought, something to think about. Feel free to reach me when you have questions at the end, and I turn it over to Katie Witry.
Hold on, Joe, before you turn it over, we have a couple more questions for you. Will
Sure.
the payment deferments be reported on credit reports?
No, it will not. So remember, you will not negatively be reported to the credit bureau, nor can they foreclose on you. Okay, so the deferment, it's a true deferment. You can defer that payment. Just realize it's not free. So if you're skipping 3 months, you owe that 3 months back at some point, and you need to check with your servicer. Is it going to be in one lump sum after all of this is over, or are you going to spread it out on the back end?
Okay, next question is someone's asking if the rates that you're talking about are probably 30-year rates. Do you have any information about 15-year rates?
Right, great question. It's been weird. So, and look, when I say a rate range of 3.5%, realize that's for a good credit score over 720 or 740. It's for a single family purchase with at least 10% down. So if you're buying a multifamily house, or if you're buying an investment property, or if your credit score is 690, you're not going to get a 3.5 rate, okay? So just realize when I say the rates, I'm giving the general rate for the normal single family purchase. So, whoops, I'm sorry, Serena, I started talking real fast. What was the point of that question?
Just what is any information about 15-year rates?
Oh, I'm sorry. So the 15, right. So I just wanted to say that the general. So 15-year rates have actually been running higher on some days than the 30-year fixed rates. It's just a weird anomaly going on right now, but there is not really a big spread between the 15 and the 30 if there is one. So I think this morning I was able to see a 3.25 or 3.1 for a 15-year. But if you can get a 30-year at a 3.3 or 3.5, it's not that big of a spread.
Thank you. And then one more. I'm going to just read this verbatim because it's a little bit long. So one of our attendees has said that they feel like COVID's not going away anytime soon, and people might be underestimating the amount of time that we might have to live or cope with this. If that's the case, how do you think the Fed might cope with that? We know you don't have a crystal ball, but any sort of educated insight would be useful.
Okay, so the Fed has basically coped with it almost as best as they could. But I don't know if they have any ammunition left, to be honest with you. The rates are as low as they can go from the Fed standpoint, which has, you know, again, I went over the risk that's in there. So from our aspect, we're expecting the call yesterday that this is going to be very volatile for the next 3 months, 90 days, okay? But we're still going to have effects after 90 days. The bottom line is, you know, we're in the midst of COVID right now, and we have low rates and we're closing on loans. So that's not a problem. Where I see a problem, though, might be in 30 or 40 days out when I try to verify employment, and those companies can't really hold on too much. You know, they say, hey, I can pay your salary now. We're getting verifications of employment. But if this rolls on another 30 days, we're going to have companies that say, I can't pay you anymore. So if the borrower is now on unemployment, and they're guaranteed to be rehired when it's all over, we can't close on that loan on unemployment. And if there's a struggle to get out of this, then, you know, yes, we'll have issues if we can't. The main thing is verifying employment. A lot of people are working now. I mean, there are a lot of people working and they're closing on their loans. But if it drags on and more people get laid off, that's an issue. I think that, you know, we need the economy to, you know, to recover. And we don't know when that's going to happen. It's a great question. I don't have that crystal ball. But, you know, it's very, in my world, if you're working, we can close a loan. And there are a lot of people working. We can name them, right? Our healthcare workers, grocery stores, people shipping. That's a healthy side. But it's the other ones, the longer that drags on, and in New Orleans, hospitality, restaurants, that could be a detriment to us until it comes out. I hope I answered that question, but
Sure, that was great. Thank you, Joe.
All right.
All right, so we are going to move over to Katie Witry, who's going to tell us a little bit more about what's going on in our housing market. Katie, you're muted.
Hello, everybody. I see in our panelists that is there any good news? That's a great question. I know that real estate and preservation of buildings is a key driver in the national economy. It is very important in our local economy. And if we look at like leap year this year, we had unemployment was low, the housing market was stable, and the stock market was at record highs. New Orleans market was sideways. Our in-migration, our out-migration has plateaued in New Orleans. And so we don't have a ton of people moving here. We didn't have a ton of people moving out of the city. And so there wasn't much advantage for a buyer and seller. Transactions were still happening and it was considered a stable market, but I wouldn't say there was an advantage for a buyer or a seller. When the recession happened in 2007 to 2013, we had an oversupply of housing. You know, in New Orleans, we had damaged housing and we're rebuilding our homes and our housing stock. We can't look at real estate without looking at unemployment. I mean, Joe, you know, had mentioned that over and over, and that is a key indicator in our market. What we know is that 40% of New Orleanians are employed with hospitality and oil and gas, and those industries are really suffering. We have enough housing stock in New Orleans. We have an affordability issue. So if we were going to renovate all of the blighted property, we have enough housing units for our community. It's just an affordability issue, which is going to lead us to also unemployment. And I definitely see that the housing market will turn into a buyer's market. I'm already seeing that happen, and that we have our spring market. Normally we're letting our sellers know like March 15th to April 15th is when you're actually going to most likely list your property for sale in a perfect world. And now, of course, a lot of those are being delayed. And we said, okay, maybe April 1st, and now it's April 15th. And now are we actually going to delay those to April 30th? Historically, May and October were the busiest months for sales in New Orleans, and I've tracked that for years. And so I think we're going to have, I know we're going to have a delayed spring market. So just as Joe was saying, if we're going for 90 days, all of a sudden the spring, you know, market and activity is really going to be pushed until the fall. And I definitely see that that's happening. I think it's important to know that you have real estate is an essential business in Louisiana. I know that in other states that it is completely stopped. So just for instance, Pennsylvania, Washington, real estate is not considered an essential business. So you cannot be showing properties. In Louisiana it is, and there's 10 different layers to a real estate transaction. You have a buyer and a seller, a realtor. You have to have the courts open. The courts are still open with limited staff from 9 to 1. So that means transfers can actually be recorded. Bankers and lenders, insurance companies, tradespeople, title companies, you know, everyone is operating on a skeleton crew and also taking the CDC guidelines. In terms of inspectors, a lot of them are just inspecting vacant homes. So we have to look at that. If you have a family in a home, if you have tenants in a home, your property is not going to necessarily be inspected. And then how do you also show it? I know that, you know, realtors were practicing that we're wearing booties inside of houses. We're wearing gloves when we're actually showing it. And any of the contracts that were currently in the pipeline, I've seen most of them close. What I am seeing that if anyone feels that their job or their health is being affected, they're putting it on pause. They're putting their search on pause. They're putting their house that they were going to put on the market, you know, on pause. But I'm also seeing individuals reach out that are employed that said that they never thought they could buy into the New Orleans market, as it's been sort of a seller's market for the last 10 years. And they're starting to see that there is opportunity. Can no one hear me? I'm starting to see. Can everyone still hear me? Yes. Okay.
Katie, I think a couple people can't hear you, but most people can. I'm not sure exactly what the problem is with that.
Okay. All right. I just want to make sure. And just to go back, we're doing also virtual open houses. Absolutely. We're doing Zoom calls. And the buyers have been good. I mean, real estate has been one of the last industries to really shift to online. I mean, you think about ordering cars and food and your groceries, you know, those industries, people have been looking online, and we just hadn't been doing it necessarily for a house once we were ready to purchase. On average, most buyers are looking online for about 1.5 years before they actually enter into the housing market. So I think that there are some virtual tools that are going to be helpful for showings, and that we're having to sign paperwork saying that we've actually seen the 3D tour, the virtual tour, and then we're interested in walking through. So there's definitely certain layers depending on, you know, what your seller's actually comfortable doing. So I think, you know, it's important to know that real estate is still considered an essential business in Louisiana for us now. in that Joe had talked about the COVID addendum. You know, after Katrina, we saw a lot of those addendums come into place. If there was an act of God, you know, what would actually happen with the real estate contract? I'm starting to see that buyers and sellers are agreeing to a COVID addendum, saying that if anyone is affected, or anyone in the transaction is affected, that in fact will have a 2-week extension, a 30-day extension, depending on where you are within the contract. I think the biggest thing is that, you know, you have to use reliable resources. You need to be mindful of your situation. Every household is going to be affected in some capacity, and everyone's situation is going to be different. I think that we have to just believe that at some point we're going to be able to interact, and this is going to change the way that we care about people, the way that we consume, and just the way that we interact. And that the housing market now is really important to know what a house is. Not everyone can shelter in place though, and I think that this is important, that once in fact, you know, evictions in Louisiana, I believe April 13th is last I heard that you're not able to. So what's going to happen if that doesn't get extended? What's going to happen that, you know, a down payment is going to be an entry to home ownership, credit scores maybe due to job loss. You know, those are the things that are going to affect it, as well as I really think we need to be mindful of our homeless, you know, and is that going to actually increase at some point? I just want to name some resources for renters that, you know, there's a lot of restaurants that are doing family meals, as well as you can reach out to Totally Community Action, as well as fair housing organizations and Jane Place to be able to help understand some renters' rights. And you just really need to rely on the voices of value and know that we're monitoring this situation. I've been in the housing market for 20 years. 5 of those was in nonprofit housing before 9/11 and then after Katrina. And we're studying as much as possible so that we can be able to share the information to the community.
Katie, so the one of the questions is, do the COVID addendums allow the buyer to get out of the contract for any reason, or for a positive test result or a job loss? Like what are the parameters on that?
That's a great question. You know, it depends. The state form is allowing people just to be able to say there's an extension and then I've also seen brokerage specific forms that says that you can actually get out of the contract. One thing about our Louisiana contracts is that, you know, as long as you're within the inspection period, you can change your mind and not proceed to move forward. It's also if it's contingent upon you being able to qualify for a loan, but at some point you're still on the hook to be able to purchase the property. So it really depends on where you are in the contract period. If you sign it up front, it just depends on how you want your realtor to actually negotiate that contract and be able to say, if something happens, I just want to be able to be completely out, but then the seller actually has to agree to that as well.
I see you're reading the questions down there. There's a question about Airbnbs and also condos when you have a second.
We're already selling off, the Airbnbs. As of December 1st, the rules changed and current permits are in place for short-term rentals. However, you cannot get a new permit license if you do not have your homestead exemption on the property. So we've been seeing that inventory for the last year and a half come into the marketplace, and we're going to continue to see that inventory, especially around the 7th Ward, Marigny and Bywater. We're definitely seeing a lot of the houses that were STRs, you know, come on the market. Has this affected, is that okay if I'm reading those? Has this affected?
Yep.
Okay. Yes, I do think it will. I think that if you are a seller, you need to be extremely strategic about your pricing. This is not the time to throw out a number out there and hope that somebody will pay you that amount of money. I think you need to be strategic and actually come up with a plan and make sure that you're pricing your house within what the market says. I did an analysis on areas of Mid-City and Bayou St. John, and I always look at the active data, the pending data, under contract data, and the sold data, because data helps guide our decisions. And last week there was nothing pending within the parameters of $300,000 to $500,000 within those. Within that micro market. And so that showed me that I have active properties, I have for sale properties, but I had nothing pending. Do you feel like, one thing I think it's going to be important is that buying is going to be similar to renting. The barrier to home ownership has definitely been credit and then down payment, but I'm starting to see that the cost of buying a house and renting is going to be in line, and it actually may be even more attractive to buy depending on the price point. Rent to own options. Oh, I would love to see that come back. I think that that's something that we should encourage our sellers to do if they have the capacity to do it. Not all sellers have the ability. Some people may decide that if they have to move, they can rent their house for 2 years and not have to pay capital gains tax. And so we may actually be seeing some sellers that have to move for work decide to rent their house and maybe not sell it right away, but maybe they would be open to rent to own.
So, Katie, are you sort of through your main talk and just ready for more questions?
Yes.
Great. So we're coming up to 2 o'clock. I know we get started a little bit late because of some of our technology issues. If folks have to go, we totally understand, but I think Katie's got a couple more minutes to answer a couple questions if anyone has anything. All right. It looks like that is it for now. We don't see any other questions coming in. So hold on one second. I am going to try to promote our executive director to a panelist so she can join us.
Is it working?
Yep.
Okay, great. I just want to thank everyone for joining us for our inaugural online class. We're very excited to be able to offer this to everyone. We know that people are at home looking for something interesting to watch and do, and so thank you for joining us. Serena and our team have come up with a phenomenal slate of really interesting classes 3 times a week, so please participate in all of them or as many of them as you'd like. They're free, and the reason that we're able to have them be free is because we are supported by so many of you through memberships. I want to promote our organization and your joining and becoming a member of the PRC. It really helps support everything we do, and it's something that never goes out of style. We all live and love New Orleans and its architecture, and we have to do everything we can to save it now and always. So thank you to all of our members. If you're not a member, I highly encourage you to join. It's very easy. Go to prcno.org. Thank you, and I look forward to seeing you all on a future talk.
All right, before I close this out, I just want to answer one quick question about whether or not this will be available. I know Susan, our communications director, just chimed in via chat that she's going to try to get all of this stuff archived on our website. I'm also in the process of figuring out how to make this available via Zoom webinar for now. We were recording the whole session, so stay tuned, and we should be able to send you all an email once this is available through the Zoom platform, again, for people to come and view the whole thing at their leisure. So we'll keep you posted on that. Thank you, everyone, and hopefully we'll see you at the next one.